Welcome to the III Licentiate IC01 Principles of Insurance Chapter 3 Explainer video from the Insurance Domain Training Center. We have launched this Licentiate video series to support candidates who are preparing for the Licentiate examination conducted by the Insurance Institute of India. Our objective is to help you understand the concepts through simple explanations, practical examples, and exam-oriented discussions that make your preparation easier and more effective. In this video, we will cover Chapter 3, Rating and Pricing of Insurance Products. Before we begin, please take a moment to read the following disclaimer.
Before we begin, please take a moment to read this important disclaimer. This video is an independent educational resource created by the Insurance Domain Training Center to help learners understand the concepts covered in the III Licentiate exam IC01. We are not associated with or authorized by the Insurance Institute of India. For examination purposes, please refer to the official study material and any instructions issued by the Insurance Institute of India, as those remain the authoritative and final source. Thank you. Let's begin our learning journey. Before we begin, here's how to get the maximum benefit from this video. This learning video is developed by drawing inspiration from Richard Mayer's pre-training principle. For this section, we first provide a detailed concept overview. Once the concept overview is complete, we revisit the same concepts with visual explanations and practical examples. This two-step approach helps you understand the big picture first and then reinforces your learning through examples. For the best learning experience, keep your Insurance Institute of India Licentiate IC01 textbook with you and follow the same chapter as you watch this video. Finally, test your understanding by attempting the chapter questions before looking at the answers. Now let's begin. In this video, we are covering Chapter 3, Rating and Pricing of Insurance Products. The objective of this chapter is to understand the difference between pricing of a generic product and an insurance product, concept of the burning cost and its calculations, and using the burning cost to decide the insurance pricing. The first section covers the challenges in insurance pricing. The second section provides detailed explanation of calculation of the burning cost. The third section focuses on using the burning cost to decide the insurance pricing. Let's begin with the first section, Challenges in Insurance Pricing, and see what it covers. In Section 1, we are covering the challenges in insurance pricing. You will understand uniqueness of insurance pricing, the importance of accurate rating in insurance, and the 4 components that help determine insurance prices. Let us go to Section 1.
Welcome to Section 1, Challenges in Insurance Pricing. Today we are going to explore a really fascinating puzzle. Just imagine trying to set a price for a product, but you have absolutely no idea what it's actually going to cost you to make. It sounds kind of impossible, right? Well, let's dive right into this. So how do you put a price tag on an unknown future? This isn't just some deep philosophical thought, it's the exact everyday challenge faced by folks working in the insurance industry. They literally have to sell you a promise today for something that might or might not even happen tomorrow. And this brings us to a huge difference between buying everyday items and buying insurance. Let's look at a super simple example. Think about buying a wooden chair. For a normal product like a chair, the seller already knows exactly how much the wood, the nails, and the labor cost well before that chair ever sits in a shop. They just total up those known expenses, add a little bit for profit, and boom, that's the final price you pay, but with insurance. The whole thing is flipped. The sale happens first. You pay your premium today, but the actual expenses, the claims, will those only appear much later because of this backward timeline. There's a golden rule in insurance. Once the policy is sold at a certain price, the deal is completely locked in. If there's a massive disaster and the future claims end up being way higher than expected, the insurance company is absolutely forbidden from going back to the customer to ask for extra premium money. They have to pay up, no matter how huge the costs turn out to be. Now this creates a timeline of real danger for the insurer. Sometimes the waiting period for these costs to actually show up can be incredibly long. Take professional indemnity policies, for example. These are meant to protect professionals if they make a critical mistake at work. So year 1 the policy is sold, maybe in year 3 a mistake actually happens in the workplace. But get this, the actual claim might not even surface until year 5. The insurer had to set the price 5 years ago. Totally blind to this future event. Because of this massive uncertainty, the stakes are just incredibly high. As our source material warns, any carelessness in carrying out these duties can threaten the continued existence of the insurance organization. So getting the price wrong doesn't just mean losing a little bit of money for the year. It can literally destroy the entire company. So how do they actually survive this? The core solution is to carefully match the collected premium to the true character of the danger. Simply put, higher risks require higher premiums and lower risks require lower premiums. It sounds simple enough, right? But measuring that risk accurately requires a lot of skill. In practice, this complex work is handled by highly educated specialists called actuaries. These actuaries use a vital 4-step chain of work to avoid disaster. Step 1 is risk categorization, carefully grouping similar dangers together. Step 2 is rate setting, which is figuring out the base cost. Step 3 is price determination, finding that final number for the customer. And step 4 is underwriting, the decision to actually accept the risk. This step-by-step process is the shield that absolutely protects the insurance company from ruin. Following the money, what makes up the final price? Now that we know how tricky it is to calculate that price, let's take a little journey. Let's follow the money and break down exactly what pieces actually make up the final price of an insurance product. The first and definitely most critical part of the price is called the burning cost. This is simply the exact amount of money projected and set aside purely to pay for the future claims of the risks they just took on. This is the real heart of the insurance promise. It's the largest, most vital chunk of the premium that you pay. Next up, we have the acquisition costs. Insurance, just like any other business, has to be sold to the public. And while a small portion of business is written directly by the company, the much bigger share comes through distribution channels. Think of your agents, your brokers, and web aggregators online. These folks have to be paid a commission for bringing the business to the insurer, and that cost is built straight into the final price. The third component simply covers the day-to-day reality of running the insurance operation itself. These are the operating expenses to keep everything functioning. The company has to pay the salaries of its staff, they've got technology costs, they have to pay the rent for their office space, and yet they even have to pay the electricity bill. All of these basic daily costs take a slice of the collected premium. Finally, we reach the fourth element, profit and a margin for error. Now, obviously making a profit is a central goal for any business, but in insurance pricing, it serves a really important extra purpose. Pricing has to include an allowance for uncertainties. It acts as a vital safety cushion if the actuaries made a mistake in their math or if the actual claim costs end up being way higher than projected. This margin for error is exactly what allows the company to absorb the shock and survive. Let's just pull all of this together into a single view. A single premium payment from a customer is carefully sliced up by those actuaries. You've got the large slice for the burning cost to pay the actual claims. You have a slice for acquisition costs to pay the agents. A slice for operating expenses to keep the lights on, and the final slice for the profit margin, complete with that all-important room for error. Every single piece must be perfectly balanced. We have seen today just how delicate this balancing act really is. Setting a fixed price today for a completely unknown tomorrow is just a massive challenge. So I want to leave you with this thought-provoking question. If actuaries get the math wrong and the insurance company is strictly forbidden from asking for more money later, who truly pays the ultimate price?
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
If you own a shop, putting a price tag on a physical object like a mobile phone is straightforward. But how do you put a price on an invisible promise? For normal retail goods, the manufacturer knows exactly what they spent before the item hits the shelf. They know the cost of parts, labor, and desired profit. They simply add those known expenses together to set a guaranteed safe price. Insurance works entirely in reverse. The customer buys the policy today, but the actual expenses for the policy happen afterward. Sometimes the true cost of an insurance policy, the claims they pay out, might remain hidden for years after the customer pays their initial premium. You are selling a guarantee about the future without actually knowing what the future holds. Let's say a doctor buys a professional protection policy this morning to cover any potential mistakes they might make in their practice. A patient might not file a medical complaint until 3 or 4 years down the road. Suddenly the insurance company has to pay out a massive settlement for a policy they sold years ago. The strict rule of insurance is that the original price is final. The company cannot go back to that doctor and demand extra money to cover the surprisingly high settlement. If the company set the initial price too low, they have to cover that massive shortfall entirely out of their own pockets because the price set on day one is locked in. Accurately predicting those future costs is an absolute matter of survival for the insurance company. The people tasked with predicting this future are specialized math experts called actuaries. Actuaries do not guess. They carefully build a safe final price by calculating 4 distinct elements. The first element is the expected claim cost. This is the estimated amount of money the company expects to pay out for actual events like medical bills or car repairs. The second element is acquisition costs. Insurance policies have to be sold, so this is the money spent rewarding the brokers, agents or websites who bring customers to the company. Third are operating expenses. These cover the daily reality of running the business, including staff salaries, keeping the computer systems running and paying the rent. The fourth element is the profit and safety margin. Actuaries need a buffer in case their estimates are off, plus enough actual profit to keep the enterprise healthy. Stacked together, these 4 calculated blocks form the total premium the customer pays, ensuring the company can weather the unknown years ahead. Pricing a normal physical product is simple addition, but pricing insurance is a delicate balancing act of risk and reward. If the actuaries are too cautious and build in too much safety margin, the premium becomes expensive and customers will simply buy from a competitor. But if the premium is set too low, the company won't have enough money to pay claims and will eventually collapse. The solution is proper risk categorization. Higher risks require higher premiums to stay safe, and lower risks require lower premiums to stay competitive. A mistake at any point in this process threatens the whole business. This is why accurate categorization and expert pricing are the vital functions that allow an insurance company to exist and keep its promises.
We are currently in Section 2. You are in the core section, which is the heart of insurance pricing. In the last section, you understood the importance of risk classification and what is burning cost. In this section, we dive deep into burning cost calculation, including frequency and severity and how loss volatility impacts the premium. The formulas explained in these sections are important for you to understand to answer related questions in the exam. So understand the calculations carefully. Let us dive in.
Welcome to Section 2 Explainer. In this section, we are going to understand what is burning cost and how it is worked out. We are going to completely demystify the mathematics behind insurance pricing, and specifically, we are going to unpack a foundational concept known as burning cost. Now, if you've ever looked at an insurance premium and wondered how on earth did they arrive at this exact number, well, you are in the perfect place. We are going to break down this seemingly complex mathematical process using simple real-world examples that will just make it click. By the end of this, you're going to see the hidden gears turning behind massive financial decisions. Okay, let's dive right into this. Here's how we're going to break it down today. We'll start with the big picture, then look at the 2 pillars of pricing, see the math in action, tackle real-world complexity, explore loss volatility, and finally, we'll put you to the test with a quick knowledge check. Alright, Part 1. The big picture. Let's define burning cost in ultimate claims. So think about the sheer massive scale of the insurance industry for a second. How do these companies actually know what to charge you without, going completely bankrupt? Well, that mathematical baseline starts with something called the burning cost. Literally, it's the overall sum of claims that must be settled for the risks they've accepted. But, and this is crucial, it's not just the raw ticket price of those initial claims. This overall sum is the ultimate cost. It's the absolute net amount the insurer is on the hook for after every single obligation under the policies they've written is fully met. To actually figure out that ultimate net amount, we've got to look at the entire chronological lifespan of a claim. It's basically a three-step process. Step 1, of course, is your base claims cost, but the insurer's expenses definitely don't stop there. Step 2, we have to add in claim handling expenses. Think survey fees to assess the damage, or maybe legal and advocate fees. Then step 3, and this is where they catch a break. The insurer gets to deduct any money they manage to claw back. So they'll subtract the value of any salvage or money recovered from other parties under subrogation rights, or even recoveries from their own reinsurers. So you do that math, base cost plus fees minus recoveries. And boom, you arrive at the ultimate claims cost. Moving on to part 2, the two pillars we're breaking down, frequency and severity. Now there are two core pillars that actually make up this burning cost calculation, and they absolutely have to be worked out totally separately for every single class of risk an insurer takes on. The first pillar is frequency. Frequency is simply the occurrence rate of losses relative to a stated number of exposure units. Now you might be wondering, what exactly is an exposure unit? It's just any unit of risk that faces the chance of suffering a loss. For example, if a single group policy covers 2,000 workers, your exposure units are 2,000, not 1. So exposure units could be individual lives, cars, houses, industrial plants, you name it. Frequency looks at the aggregate number of losses that pop up from a given volume of those units over a set time, usually a year. Basically, frequency just answers the question, how often are these losses going to happen? The second pillar is severity. And here's the thing, frequency only tells us how many losses to expect, right? It gives us absolutely zero clues about the actual size of those losses. That's where severity steps in. Severity is the average size of a loss that we can anticipate within a group of exposure units. If frequency is the how many, severity tells us how much those losses will actually cost on average. And this brilliantly illustrates a really major difference between life and non-life insurance. With a life insurance contract, the payout is a fixed sum. The specific event happens, like death. A set agreed upon amount is customarily paid out. Easy. But most non-life policies like your car or home insurance, they operate on an indemnity basis. That means the payout equals the actual monetary loss sustained, which means it fluctuates. So one claim might be a total loss where the whole sum insured is paid out, but the very next claim might just be a minor partial loss minus depreciation and deductibles because those loss sizes fluctuate so wildly from case to case. In non-life insurance, an average loss amount has to be nailed down. And that, my friends, is our severity. Alright, part 3, the math in action. Let's combine these pillars. So let's actually see how these two pillars come together to give us our magic number. The burning cost is found simply by multiplying frequency by severity. Let's walk through the formula here. Frequency is the number of losses divided by the number of exposure units, and we take that and multiply it by our severity, which is the total amount of losses divided by the number of losses. Okay, but here is the absolutely brilliant part. Look closely at the math for a second. The numerator in the frequency formula and the denominator in the severity formula are identical. They both say number of losses, so mathematically they just perfectly cancel each other out. It's so clean. When the dust settles, burning cost simply equals the total amount of losses divided by the number of exposure units. Just wonderfully elegant, right? Let's anchor this math to a real-world scenario so you can really see it in action. Imagine we have a group of 5,000 identical residential houses. Same construction standard, same neighborhood. Every single house is valued at 200,000 rupees, and they're all insured solely for fire damage. Now, historical records tell us that on average, 10 out of those 5,000 houses will suffer fire damage in any given year. Since each house is fully settled at 200,000 rupees, those 10 fires mean our insurer is going to need a total claim fund of 20 million rupee to cover everything. So how do we find the burning cost per house? Well, we take that total claim we need, 20,000 rupees, and we simply divide it by our exposure units, which is those 5,000 house owners. Do the math, and that gives us a burning cost of exactly 400 rupees. It means if the insurer collects just 400 rupees from every single one of those 5,000 homeowners, they will have generated the exact 20,000 rupee fund they need to cover the expected losses. Pretty cool, right? Moving on to part 4, real-world complexity, because, well, we have to go beyond the basic formula. Okay, the 400 rupees calculation was super clean and incredibly satisfying, but I got to give you a bit of a reality check. That formula, it's really just a starting point. In actual practice, the real world is way messier. When an actuary is actually rating just one single product, they have to juggle a massive list of moving parts. We're talking recent claims trends, wild shifts in policyholder behavior, or even a sudden court decision that drastically bumps up the final size of losses. They have to factor in their own reinsurance treaty structures, the overall economic weather, and specific policy conditions like copays or deductibles. They even have to look at the psychology of the product design itself. Like a premium version of a property product usually generates a higher severity of claims than a basic one, even if the actual base coverage is identical. Just because people paying for premium expect every single expense to be met. Without question, every single one of these influences has to be carefully weighted. Alright, part 5. Loss volatility, the wild card of standard deviation. Here's the thing. Average loss per exposure is really only half the story. The real hidden danger in insurance pricing is loss volatility. And to visualize that danger, we look at standard deviation. Basically, standard deviation quantifies how wildly individual values scatter around their average. Now it's really interesting here is comparing data set 1 and data set 2. Both sets share the exact same average of 10, but data set 1 has a low standard deviation of just 1.58. Those numbers are tightly to that average.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
How does an insurance company look at a neighborhood like this and decide exactly what to charge one single homeowner for a year of protection? They start by arriving at the burning cost. This is the total amount of money the company expects to pay out to settle every claim for the risks they've accepted. To find that amount, they look at the ultimate claims cost. They take the base cost of the claims, add in the fees for surveyors and lawyers, and then subtract any money recovered from selling scrap or from other parties. Arriving at that final number requires us to look at the specific factors, how often these losses happen, and how large those losses usually are. By calculating these two factors for every type of risk, an insurer can build a pool of money designed to meet their obligations to the policyholders. To measure how often things go wrong, we look at exposure units. Here, that's 5,000 identical houses. Historical records show 10 typically suffer fire damage yearly. To find frequency, we divide those 10 expected losses by the 5,000 houses covered. This gives us the rate of occurrence, but it doesn't tell us anything about the actual financial impact of those fires. Knowing how often a fire breaks out is only part of the calculation. The insurer also needs to determine the average cost of the damage. Suppose the total cost to fix all 10 damaged houses is 20 lakhs rupees. We divide that 20 lakhs total by the 10 individual losses to get an average loss of 2 lakhs rupee per house. This average is what we call severity. Severity gives the insurer a reliable baseline for the financial impact of each claim, even if the actual damage varies slightly from house to house. To find burning cost, we multiply frequency by severity. The number of losses appears on top and bottom, so they cancel out. Multiplying our frequency of 10,5,000 by our severity of 2 lakhs rupee resolves to exactly 400 rupees. This means, if the insurer collects just 400 rupees from each of the 5,000 families, they'll have the 20 lakhs rupees needed to pay for the 10 expected fire claims in full. In reality, claim sizes aren't always so predictable. Changes in repair costs or even court decisions can make the final bill for a claim move up or down. This unpredictability is called loss volatility. It measures how widely individual claims are scattered away from the average. A spread known as standard deviation. Both of these products have the same average severity of 50,000 rupees, but for product X, the claims stay very close to that average. For product Y, the claims are all over the place, swinging from 20,000 to 80,000 rupees. Because product Y is so volatile and unpredictable, insurers have to add an extra financial margin to the premium. This protects them from being caught off guard by a series of unexpectedly large losses. Let's try a quick calculation. A company insures 5 groups of employees with 1,000 people in each group. The total claims for the year across everyone come to 30 lakhs rupees. Based on that, what is the burning cost per employee? We know we have a total of 5,000 employees across all the groups. We just divide the 30 lakhs total claims by our 5,000 employees. That gives us 600 rupee. Option D. Understanding how frequency, severity, and volatility work together allows insurers to move past guesswork and price their protection accurately and fairly.
Welcome to Section 3. In this section, you will be learning the way insurance companies convert burning cost into final premium and the nature of pricing process. Let us dive in.
Welcome to Section 3, Insurance Pricing Using Burning Cost. We are going to look at something genuinely fascinating today, figuring out exactly how insurance companies calculate their prices using some really simple, elegant math. By the end of this explainer, you'll know the precise steps insurers take to arrive at that final premium you pay. It's a seriously clever process, so let's just get right into it. Okay, let's dive into this. The central question we're tackling today. Is this how? Insurers take all that raw claims data and transform it into your final premium. I mean, when an insurer looks at historical accident data, all they see are raw numbers, right? So what does that transformation into a neat final price tag actually look like? Why, the whole thing starts with a critical foundation, the burning cost, which is sometimes called the pure premium. Simply put, this is the exact chunk of money the insurance company absolutely has to set aside just to pay future claims. That's it. It doesn't. Office rent. It doesn't include profit margins. It's purely the cash required to cover those expected ultimate claims from the premiums they take in. Let's use a really straightforward example to ground this. Imagine a theoretical insurance product where our burning cost is exactly 900 rupees for each exposure unit. So for every single policy they sell, the insurer needs 900 rupees sitting safely in the bank just for the expected claims. We have to protect this 900 rupees at all costs. It's our absolute baseline. But here's the catch. Insurers have a lot of other bills to pay, not just claims, right? They've got acquisition costs, which is what they spend to actually get the business. And let's say that's 15% of the premium. Then you have operating expenses, keeping the lights on, running the offices, that's another 15%. And of course, they need a profit margin. Let's peg that at 10%. So when you add up that 15, 15 and 10, we're looking at a total loading of 40% in extra expenses. Now here is a classic trap that so many people fall into. We know we need 900 rupees for our burning cost, and our extra costs are a 40% loading. Common sense might whisper, hey, why not just increase that base 900 rupees by 40%, right? Because 40% of 900 is 360. And if we just add those together, we get a nice final premium of 1,260 rupees. But ask yourself, is that actually correct? Can we just slap that percentage directly on top of the base? Absolutely no way. Let's walk through the math step by step to see exactly why that simple addition completely fails us if we charge a final premium of 1,260 rupees. Remember, our expenses are a percentage of that final number. So we pay out 15% of 1260 for acquisition, that's 189 rupees. Another 15% for operating is another 189 rupees. And our 10% profit cut, that's 126 rupees. Add those up, and our total outgo for expenses is 504 rupees. Now, if we subtract that 504 from our 1260 premium, we are left with a balance of just 756 rupees. We are dangerously short of the 900 rupees we actually needed to pay claims. Those percentage-based expenses ate right into our crucial base cost. So the crucial point is this. We simply cannot just add the expense percentages on top. It doesn't work. Instead, we have to use a completely different mathematical approach to find the true premium. We take the burning cost and we divide it by 1 minus the total percentage of those cost elements. Honestly, you can think of this as the absolute golden rule of insurance pricing. Let's see how this magical formula builds a correct premium step by step. In step 1, we take our burning cost of 900 and we divide it by 1 minus our total cost elements, which is 40%. Moving to step 2, 40% leaves us with 60%. So we are basically dividing 900 by 60%. And finally, in step 3, 900/0.60 gives us a final correct premium of 1,500 rupees. But we should probably double check our work just to be totally sure. And this brilliantly illustrates why this specific formula is so incredibly important. Let's pressure test a new premium of 1,500 rupees. We pull out 15% for acquisition, that's 225 rupees. Another 15% for operating is 225 rupees. And that 10% profit is 150 rupees. That means our total outgo is 600 rupees. Now take our starting premium of 1,500, subtract that 600 rupees of expenses and look at the remaining balance. It is exactly 900 rupees. Boom! Our burning cost is perfectly protected. Okay, so now that we have the math absolutely nailed down, we have to pull back and look at the real world. Setting that final premium is a really delicate balancing act. If an insurer sets a super high premium, sure, they cover all their costs safely, but their rates end up way higher than competitors. That leads to low volume, and they lose customers. On the flip side, statistical predictions like calculating that burden cost only really work when you have a massive pool of customers if you try to gain that. High volume by underpricing the funds you collect will simply be insufficient to meet the expected claims. Both of those extremes are just incredibly dangerous for a business. And that brings us to a really crucial final thought. An insurance company is constantly trying to maintain this careful equilibrium between the size of their customer base and the actual money they generate. And that balance shifts all the time because market conditions change literally every single day. So what you have to ask yourself is, how will you maintain equilibrium as market conditions continuously shift? Real-world pricing requires a highly measured approach, but it has to be built on the rock-solid math we just explored. Thanks for watching Section 3 Concept Explainer.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
This animated diagram breaks down the foundation of insurance pricing. The primary block here is called the burning cost, sometimes known as the pure premium. This is the exact amount of money the insurer needs to collect just to pay out future claims. But an insurance company has to cover other expenses to keep the doors open. We add an acquisition cost of 15%, operating expenses of 15%, and a required profit margin of 10% when we combine these three business expenses. We get a total loading of 40%. Let's apply this to a specific baseline scenario. Our expected burning cost is fixed at 900 rupee per exposure unit, and it sits right alongside our 40% loading requirement. The core challenge in pricing is figuring out how to mathematically combine this fixed 900 rupee cost with our 40% loading to arrive at a final premium that fully funds the business. Under our common mistake heading, the intuitive approach increases the $900 burning cost by 40%, setting the premium at $12,160. But if the company extracts its required 40% for operations $504, only $756 remains. For the claims fund, We needed exactly $900. The error happens because the 40% deduction is taken out of a larger total premium, while the original edition was based on the smaller burning cost. That mathematical mismatch starves the claims fund. To fix this, we use a different formula. The premium equals the burning cost divided by 1 minus the percentage of the cost elements. Let's substitute our baseline numbers 901, 40%. We simplify the denominator first. 100% represented by the 1, 40% leaves us with 60%. Take a few seconds to calculate this yourself. What is 900/60% or 0.60? The resulting premium is exactly $1,500. Let's verify that against the business requirements. The company takes its 40% loading from the 1500 premium, which is 600. That leaves exactly 900 rupees perfectly, refilling the required claims fund. Dividing the baseline cost by the inverse of the loading percentage is the only way to generate enough revenue to pay for operations while keeping the claims fund exactly intact. Setting the premium requires maintaining an equilibrium between premium price and number of customers. If prices are too high, the customer base shrinks and statistical data to predict claims becomes erratic. Conversely, heavily underpricing to attract volume means revenue won't cover actual claims. Maintaining this equilibrium requires actuaries to continuously monitor shifting market conditions and update their claims patterns based on incoming data. This cheat sheet consolidates the process. Step 1 is ident. Buying burning cost. Step 2 is identifying necessary loadings. Then apply the structural formula, remembering never just add the percentage. Shifting market conditions will dictate your pricing strategy from month to month, but applying the correct burning cost math ensures your company actually retains the capital required to survive. Thank you for watching animated video for section 3.
Congratulations! You have completed all the lectures in Chapter 3. Now it is time to test your knowledge.
Next is testing your knowledge of what you have learned in this chapter. We have prepared 10 questions to help you assess your understanding of the concepts covered in this video. For each question, we will read out the question and the answer choices. You will then have a few seconds to think and choose your answer. In the following slide, we will reveal the correct answer and explain why it is the right choice. So, let's begin with question 1. Question 1. Fill in the blanks. The opening step in the pricing process is to arrive at the dash, which represents the overall sum of claims that must be settled for the risks that have been accepted. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B, burning cost. The opening step in the pricing process is to arrive at the burning cost, which represents the overall sum of claims that must be settled for the risks that have been accepted. Question number 2. In contrast to ordinary goods and services where expenses are known before sale, how does the pricing of insurance products operate? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. The sale happens first and the actual expenses appear afterward. The insurer must set the price at the moment of sale, no matter how large eventual claims turn out to be. In insurance, the sales happens first and the actual outgo known afterward. Next question is question number 3, fill in the blank. Complete the following statement. Burning cost is also known as dash. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B, pure premium. Please note that the burning cost is also known as pure premium and both are synonymous. Next question, question number 4. Acquisition costs refer to the outlay required to secure and obtain business for the insurance company. Which of the following is typically paid under acquisition costs? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option D. Commissions and brokerage to agents, brokers, or web aggregators. Greater share of business arrives through intermediaries like agents, brokers, and web aggregators, and the payments to these parties are called acquisition costs. Next question. Question number 5. An insurer is calculating the ultimate claims cost for a portfolio. They have a basic claims cost of 15 lakhs. Survey fees of 50,000. Advocate fees of 30,000. Salvage recoveries of 1 lakh. And recovery from reinsurers of 4 lakhs. What is the ultimate claims cost? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option A. 10 lakhs and 80,000. Ultimate claim cost is claims cost plus survey fees plus advocate fees minus salvage recoveries minus recovery from reinsurers. So in this example, ultimate claims cost is equal to 15 lakhs plus 50,000 plus 30,000 minus 1 lakh minus 4 lakhs is equal 10 lakhs and 80,000. Next question is question number 6. A non-life insurer covers 8,000 identical and independent exposure units, dwellings, in a region. Historically, 16 of these dwellings suffer a loss in a year, and the average loss size, severity, is 5 lakhs. What is the burning cost per exposure unit? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The answer is option B, 1,000. Burning cost is achieved by multiplying frequency and severity. Frequency is calculated by dividing number of losses by number of exposure units. Here the number if losses is 16. Number of exposure unit is 8,000. Dividing these two will get a result of 0.002. Then we need to multiply this by severity, which is 5 lakhs, where you will get burning cost as 1,000. Using second method also the result is rupees 1,000 as depicted in the slide. Next question number 7. An insurance product has an estimated burning cost of 1,200 per exposure unit. The loadings are acquisition costs at 20% of the premium, operating expenses at 10% of the premium, and profit margin at 10% of the premium. What is the correct final premium that should be charged to maintain the required burning cost? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B, rupees 2,000. To calculate, we need to add up the percentage of cost elements like acquisition, operating and profit, which totals to 40%, meaning 0.40. Then we need to apply the formula, which is burning cost divided by 1 minus percentage of cost elements. So it is 1,200 divided by 1 minus 0.40. Then the result is 2,000. You can see the details of the calculations in this slide. Next question. Question number 8. Regarding standard deviation and loss volatility in insurance pricing, find out which of the following statements is incorrect. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B. If two coverages have the same frequency and severity, they will always have the exact same loss volatility. This statement is incorrect. Having same frequency and severity does not guarantee same loss volatility. Next question. Question number 9. Which of the following items is dissimilar to the other 4 options in the context of the basic components that directly determine the price of an insurance product? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option E, salvage value. Salvage value is a deduction in calculating ultimate claim cost, whereas other options are additions. Next question. Question number 10. In insurance, an exposure unit is defined as. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B. Any unit of risk that faces the chance of suffering a loss. As per the definition, fundamental unit of risk facing the potential for loss is called as exposure unit.
We came to the end of the chapter. Hope this video is helpful. If it is helpful, please like the video. Subscribe to our channel to get notification when we upload new video. Join our mailing list in www.insure.com. Please feel free to provide your comments and feedback for us to improve better. Thank you very much for watching the video.